Now let's look at right, rights as well as scrip issues, which are typically some mechanisms which the companies can try to issue new shares, and those by companies which have already been quoted in the stock exchange. Those companies which are already quoted on the stock exchange, they can use these kind of mechanisms to issue new shares. Probably when I'm looking at the rights issue, it is all about companies which want to raise new capital, especially new ordinary share capital. They can go for a rights issue, and who wants to increase the number of shares without raising new money, they can go for a scrip issue. So both of them will bring new shares into the market, and all the market related ratios and calculations will be done on the new shares coming. So now let's start looking at one by one. Let me start off with the rights issue. So the main objective is the company wants to raise more money, and this company is already quoted, and they want to issue further new shares. They have already finished an IPO. They want to go with further new shares. So first of all, these new shares will be offered to the existing shareholders. Initially, the new shares will be offered to the existing shareholders, and that is what will become one of the rights of the shareholders. Initially, get the new shares in proportion to their ownership in the company, and the price would be specified at the outset, and generally this price would be a kind of a discount to the current market price of the share. And the main thing what happens as a part of this rights issue is, one, there are new shares that are getting created in the market. Two, the company is able to raise additional capital, right? Because each new share is coming at a particular price. So which means the overall value of the company is increasing. Along with the current position, new capital also has come out. So the value is increasing, but what we see is price per share, that would be decreasing. It would purely be based on what is the discount that has been offered, and how many shares have been offered at that particular rate of discount. So all these will typically drive what would be the typical fall in price following a rights issue. Now, why does the company go for a rights issue? What is the main need for companies to go for rights issue? One straightforward requirement is they need more money. They could have gone into a loan taking exercise, or they could have tried out any other mechanisms, and rights is one such mechanism. But again, when you start looking at what is the reason for needing more money so quickly, probably every company will have a different kind of an answer. Someone may say, or it can be looked at that the company has expanded so much, right? The company has been into a series of expansions. Now it is in a cash requirement. It has purchased excessively, it has bought the companies, it has expanded geographically, so cash is required for the company. Or probably it is looking for a takeover, so it requires some amount of cash. So some positive sides like this, or probably it wants to it wants to expand again, it needs money for taking care of the expansion processes. Or in some cases, yes, it wants to reduce its debt to equity ratio, or probably it is already having some kind of a fundamental cash problem, so it wants to bridge that by having more money. So in some cases they are positive kind of mechanisms, in some cases they are negative. Now, how the stock market really reacts after this rights issue fully depends on for what purpose the company is really going for a rights issue. If the purpose is going to be a positive expansionary kind of a purpose, obviously the stock price might rise following a rights issue. But if the purpose is going to be purely a cover up to the cash problems, or purely to meet up the immediate problem, then obviously we see that the stock price may have a negative impact, right? How does this typical timetable for the rights issue go for? Right? If I am seeing the timetable, few weeks, few weeks before the rights issue. Now, the company is discussing the possibility with the advisors. What would be the typical impact on the company because of this rights issue? And it is generally suggested identify a time when the stock prices are much higher, because even if some discount is given, the price will still be higher and the company can mobilize more money, because at the end the investor will be paying whatever is the price at which it is fixed. So more money can be raised. So one side they will always see the timing wise, when the stock price is high, they would like to price this particular right. And there is a rights offer document which would clearly mention the purpose for which the company is going for a rights issue. And even the shareholders will be sent. Now this document, along with the uh, allotment letters to the shareholders, provisional allotment letters will be sent to the shareholders, and shareholders have to respond to that. Shareholders will be respond to that within 3 to 4 weeks, whether they are going to accept that new shares or sell their nil paid shares. What is this nil paid share? It's a right. They have got the right from the company, but they did not pay anything for the right. Right? When you are talking of a typical call option, there is a premium that is paid to get the right. Whereas in case of rights issue, they have got a right for which they have paid nothing for it. So they can very well sell that right to others and they can make money out of it. So they can decide whether they want to accept and purchase the share at that reduced price or sell that right to someone else, because the rights themselves can be traded. The rights themselves are traded, and right on the day the provisional allotment letters are being sent out, the share will start getting traded ex rights. Removing the rights component, the share price will be traded, which means the rights component is separated from the share and both of them are traded separately. The share price will drop by the extent of the rights component that is built into it. And so which means what will happen to the share price? Now what I could see is, if you look at the market capitalization of the firm initially when there was no rights issue, the price, which was the initial price, multiplied by the number of shares initially. Now with the rights issue, this market capitalization will get increased by the additional value or additional amount that the company is going to raise, right? So this would be the new market capitalization, and if I am dividing it by the total number of shares, now initial shares are S1 and probably some new shares that are got created because of the rights. This equation would result in the P2, which is typically the price per share after the rights issue. Now, what would determine this P2? First thing, bluntly put, the amount, the new money that is raised, that is going to determine the P2. But along with that, there could be expenses which the company might have incurred to come out with this issue. In some cases, in many cases, even this issue would be underwritten as well. So there are different kinds of expenses the company would have incurred in arriving at this particular issue. And along with that, probably there could have been a positive or a negative change in the market's perception. The market would have reacted positively or negatively to this company's move of going with a rights issue, because they will try to understand for what purpose the company is going with a rights issue, and based on that they are going to react either positively or negatively. So these three on a broader scale are going to determine the price. But generally, on a quick note, if I ignore these two aspects and only look at this in terms of calculating, this is what we call as the theoretical X rights price. Right? I'm looking at the theoretical X rights price, which is based purely on the new money that the company is willing to raise, and along with the existing market capitalization, these two put together divided by the total number of shares the company would have accumulated after the rights issue. And this theoretical price is nothing but the weighted average. Now if I see here, right, this money MC1 plus A divided by S1 plus R. Now I could really see if there are N shares initially, right? If initially there are N shares, or probably let's look at like this. We had P2 MC1 plus A divided by S1 plus R. Now here R I can very well look at the number of new shares that got created with rights. Probably if I say S2 for S1, which means for every S1 shares, I'm going to get S2 shares. So overall new shares for S1 shares, let's say I'm getting some S2 shares, all I can talk about is the number of new shares that are coming up is S2. I mean, or if I'm saying for every one new share, S2 new shares are getting created, then for every S1 share, which is the total number of shares the company is having, S1, S2 new shares are getting created. Right? For every one existing share, if I am saying S2 new shares are getting created through the rights issue, because there are S1 new share, S1 total existing shares, I can say S1, S2 new shares are going to get created. So the total number of shares that are there is S1 plus S1, S2. Now, let's say the market capitalization, initially it was MC1, which was nothing but P1S1, and the new money that I am raising, how many new shares I am issuing now? The new shares that I am issuing is S1, S2. S1, S2 shares are getting issued with a discount of, at a discounted price, let's say P2. S1, S2 shares are getting issued at a discounted price of P2. So the overall market capitalization becomes P2 times S1, S2 divided by S1 plus S1, S2. That is the total market capitalization divided by this. Now, if I look at this situation, probably taking out S1 across, I'm going to get P1 plus P2 S2 divided by 1 plus S2. So it looks as if we are going with a weighted average. Now you could clearly see, in case we are talking here, we have talked about one existing share, S2 being the number of new shares that are getting created through the rights issue. So if there are, so in a simple way I could see it's a weighted average, right? P1 plus P2 times S2 divided by 1 plus S2. So that is what is coming out to be the new price, new theoretical price post the rights issue. And we could very clearly see that it is the weighted average of the initial price before the rights issue and the price at which the new shares are being offered in the rights issue. And because the new shares are offered at a discount, the X right share price will always be lesser than the original price. But here we are considering only that the new money is taken into consideration. I'm not taking into consideration the expenses and even the market perception. But okay, computing the expenses probably would have been an easier step. But incorporating the market's perception, calculating the market's reactions, all these things are going to be a very difficult exercise. And at least initially, for the first few periods, what you see is following a rights issue, the market will see a little bit of downward movement because there are so many negatives here. Probably you see this scenario. One, the shareholders, they really don't like the concept of more money being asked. So why is this company really asking for more money? some number of shareholders will lose some kind of interest in the firm. And probably if they start feeling that the company is in trouble, so that's the reason they are asking for more money. That would have an impact on the share price. And there are some people who may not be interested to increase their exposure to the company. So they are not interested in buying new shares. And if they are not interested in buying new shares, because new shares are coming into the market, the control percentage is going to reduce. So even they may not be interested for this rights to get implemented. So all these things really cause some kind of initial depression in the market, but just after the rights issue. And the shareholder who does not want this right, either he may not be having a cash with him and he is not willing to increase his exposure. So all these things could have contributed to he being dissatisfied because his control percentage is going down. Now this is where the shareholder can sell the nil right. The nil paid right actually comes out as X right share price minus the rights issue price. Now probably just to see, let's understand this. Initially I'll take a simple numerical for you to explain. Initially there are 100 shares of a company, each sold at $50 a share. So the initial market capitalization was 5,000. Now the company wants to issue 20 new shares at a $40, a discounted price of $40. So which means now this will become the rights issue price. So the rights issue price is $40. And now in case I'm not interested as a shareholder, I'm not interested in exercising this right, I can sell my nil paid right. Now first of all, after this rights issue, X right selling price, X right share price, what is it going to be? I'm taking it as a weighted average. 100 new shares into $50 per share plus 20 new shares into $40 per share divided by 100 plus 20. So overall it is around 5,800 divided by 120, causing it around $48 per share. Now $48 per share is the X rights share price. So which means if I have to sell my right, I would try to sell it in the market somewhere at around $8. That is the price I can receive for selling my right in the market, and I can still receive once I am selling off my right, someone can purchase the share at $40. So overall I'm still getting around 48. So that is what typically happens in a regular rights issue. Rights issue generally goes, the price in a rights issue generally goes at a discount to the market price only. Very rarely it will either be the market price, but majority of the times it is going to much lesser than the market price. And logically speaking, they don't need to be underwritten because they are being offered to the existing set of shareholders only. And that too, if the discount is much higher, probably there would be a lot of shareholders who would be interested in going for the issue. So instead of probably paying a fee to the investment house, to the issue house, the companies may very well think of offering a higher rates of discount, and that could reduce the requirement for underwriting. But still, companies do go for an underwriting because that will increase the certainty for a company that they can raise the full money, that they can typically raise whatever is the money that is desired, and the whole issue will get subscribed to. But if some company really wants to avoid the underwriting route, the better thing is offer more and more discount. Now, in all this, everything is fine. Either the shareholder can exercise the right, or he can sell his nil right, nil paid right. But what if the shareholder does not do anything? This is where what the stock exchange does is it will insist that the company should sell those shares which are not responded by the shareholders, and whatever the benefit that came out, that benefit, whatever is the premium, which is the difference here, whatever is the benefit that came out, that has to be shared with the investors who did not exercise their rights. So it's as good as probably those investors have sold their rights. So the company is trying to sell the shares on behalf of the investors. Whatever is the difference they have got, that would be settled among settled among those investors who did not exercise the rights. So that is what typically happens as a part of the rights issue, which is again a very essential mode of raising capital in case, for at least for those companies which have already been listed and which are looking for more new shares to come into the market. Right now, we can look at the other mechanism which really is another way of increasing the number of new shares but may not raise additional capital, which is the scrip issue, right?